So this is the first lecture in chapter 14, which is the budgeting decisions. Budgeting decisions. One of the good examples or good applications for the decision making again. If you remember chapter 13, we talk about the decision making also. What are the decisions that we discussed in chapter 13? The first one was what? Make or buy, add or drop. Make or buy, add or drop. And the other one is special order. And the last one that we did, the joint products. In addition to the limited resources, we discussed 5 actually subjects in the chapter. The most important, starting with the add and drop, special order, joint products, and the last one is make or buy. Make or buy. So I'm trying to make a decision. That's why the second question for in the any exercise for the chapter 13 was, what is your advice for the company? Should you recommend, accept or reject? What is the financial advantage or disadvantage for the decision? Now, for chapter 14, we also have some decisions under the title, budgeting decisions, budgeting decisions. So typical capital budgeting decisions related to plant expansion, equipment selection, equipment replacement, lease or buy, the cost reduction. So these are some examples about the decisions that we have to make in chapter 14. So the capital budgeting tends to fall into 2 broad categories: screening decisions, and then preference decisions, selecting from among several competing courses of action, which is more than one product. We will discuss 3 things actually for the chapter: cash flows versus the operating income, cash flows versus the operating income. We discussed the operating income in chapter 13. So our decision depends on a positive or negative advantage or disadvantage for chapter 13. Chapter 14, we will discuss something called cash flows. Cash flows, if you didn't hear about it. One decision is talking about payback period or payback method, the net present value, and the internal rate of return. These methods of analyzing the cash flows associated with the capital investment project. The simple rate of return method focuses on incremental net operating income. Let's see, what do we mean by the cash flow methods? Cash flow methods. Have you heard about the cash flows? Cash flows. We do have cash inflows, which is the cash expected to be earned by the project, and the cash outflows, which is the cash that I have to pay in order to serve the project. So we do have some typical cash outflows. If we repair or make some maintenance, this is a outflows, which is cash to be paid. Incremental operating costs, this is outflows. Initial investments, which is the amount that I have to pay for the project, this is called outflows also. And the working capital is a cash outflows. The word cash inflows and the word cash outflows, which is the cash that I'm waiting to receive, and the outflows, which is the cash that I have to pay for the project. Some examples about the inflows. Salvage value is an inflow. What is the salvage value? Salvage value, which is the market value for the asset at the end of the life. The market value of the asset at the end of its useful life, which is a salvage value. So I'm waiting, this is the meaning of the cash inflows. I'm waiting these cash inflows to be received at the end of the life of the asset. Incremental revenues, which is the revenues earned by the project, and I'm waiting to receive also these cash. Well, that's why it is called cash inflows. Resale, the working capital, which is also a cash inflows. What is the meaning of the value of money? And That's why we need it in chapter 14, the value of money. $1 today is worth more than $1 a year from now, which is last year or last 2 years or last 10 years. The $100 today is not equal to the $100 for 5 years back. Okay, that's why we need to discuss the word present value of the money or present value of the project, and we need the value of money. Therefore, projects that promise earlier returns are much better than projects promises later return. If you think about two projects, then definitely you will think the shorter, the better, the shorter, the better, definitely, because the value of money, okay? The capital budgeting techniques that best recognize the time value of money are those that involve discounted cash flows. The word discounted cash flows means I have to calculate, let's say, what is the present value of all cash flows expected to be earned in the future. What is the time? What is the value of these cash flows today? This is the meaning of the word present value. I think you heard about the present value in finance, maybe, or in intermediate one, accounting one, maybe. I don't know. But we have to heard about the word present value. What is the present value means? The value of the money today. I'm waiting to receive, let's say, for the next 10 years, cash flows X amount for each year. But it is not equal to 10 multiplied by the amount today. No, we have to calculate something called present value. That's why we need to use something called factors to calculate the present value, which means, or the idea here, the time value means the $100 today is definitely not the $100 5 years ago. One of the most easiest methods to evaluate your project called the payback period. Payback period. What does the payback period means? The payback method focuses on the back or payback period, which is the length of time that it takes for a project to recoup its initial cost out of the cash receipts that it generates. So if I pay $100,000 for a project, how many years, how many months should I need to repay the 100,000? This is called the payback period. In Arabic, it is called what? What is the translation in Arabic? Translation in Arabic, فترة الاسترداد. فترة الاسترداد, which means how many months or years or what is the time that you repay your initial cost. The payback method analyzes the cash flows. However, it does not consider the time value of money. And this is the shortcoming or the disadvantage of this method. When the annual net cash inflows is the same each year, this formula can be used to compute the payback period. Payback period is equal to investment required divided by the annual cash inflows. Investment required divided by the annual net cash inflows. Example, suppose that the management at Daily Grind wants to install an espresso bar in its restaurant that costs $140,000 and has a 10-year life. 10-year life. My project is for 10 years. I will pay now $140,000, will generate annual net cash inflows. What is the word net cash, by the way? Net cash inflows, which is the difference between the outflows and the inflows. So I can earn net cash inflows for $35,000. So the management, or one of the assumptions for the management, requires a payback period of 5 years or less. This is the criteria that I will invest in my project. If the money will come back in 5 years, I will accept the offer. Otherwise, I will reject. So the management requires a payback of 5 years or less. What is the payback period for the espresso bar? Simply, we will say The payback period is equal to investment required divided by the annual net cash inflows, which is $140,000, the cost or the initial cost that I have to pay for the project, divided by what? The net cash inflows comes from the project. So we have a payback period of 4 years, which means if I operate this project, the initial cost will come back in 4 years. This 4 will be compared to what? To the criteria that the company has. So the company has a criteria of 5 years. So what is the decision? To accept or to reject? To accept, because the payback period is less than my criteria. According to the company's criterion, management would invest in this espresso bar because its payback period is less than 5 years. Good. Easy. Consider the following 2 investments. Initial investments, 100,000 for X, 100,000 for Y. Year 1 cash inflows 60 for X, 60 for Y. Year 2 cash inflows 40, 35 respectively. Year 3, 0 for X, 25 for Y. Which project has the shortest payback period? By the way, in this case, we don't use the formula Y. This formula, the formula that we use in the previous example, because it is not equal. Here, the annual net cash flows will be equals each year, okay? So the same inflows for each year, I can use this formula. Like, suppose that I give you the inflows for each year. What is the solution then? What is the solution? Without the formula. Why?
Because in the second year,
we can cover the initial cost. So without using the formula for this example, I can count. I will say I need to recover the 100,000 for both projects. So for X, in year number 1, 60. In year number 2, 40. I recover the 100,000. In project Y, we have 60 and 35. So X will have a shorter payback period. Without using the formula, if the cash flows or cash inflows are not equal for each year, I can count up to the what? Up to the initial cost. So in this case, I have to invest in project X because it has a shorter payback period. By the way, what is the payback period for Y? We need 2 plus 2 something, right? And the something depends on how much is the value remaining for the project, which is 5,000. So I have to calculate what is the fraction. Now, project X has a priority payback period of 2 years by counting, not using the formula. Project Y has a payback period of slightly more than 2 years. Which project do you think is better? Definitely it is XY, because we can recover our investment in 2 years only, and the other one is more than 2 years. This is the meaning of the payback period, how to calculate it using the formula or using to count the in-cash or cash inflows. The shortcomings or disadvantages of the payback period, it ignores the time value of money, and this is the most important maybe for the investment in huge projects. Definitely they care about the time value of money. Assume that we are talking about an amount, and you will have this amount in 20 years, but the 20 years does not mean the total amount. We have to think about the time value of money, which is referring to something called present value of the project today. Ignores the cash flows after the payback period. Suppose that a project will have, referring to the examples that we have just now. Suppose that project Y generates more cash flows after the 2 years comparing to X. So what are the cash inflows after year 2? In year 3, 4, 5, 6, 7, maybe Y will be better than X if we calculate something called the cash or the present value of the cash flows. So it will ignore the cash flows after the payback period, which is also important. Shorter payback period does not always mean that the investment is desirable, which is also happen in practice. So these are the shortcomings of the payback period. The advantages for the payback period saves as screening tool. We can decide directly from the number, identifies investments that recoup cash investments quickly, identifies product that recoup initial investment quickly. Payback and uneven cash flows. When the cash flows associated with an investment project change from year to year, like the example that we just have, the payback formula introduced earlier cannot be used, yes. Instead, the unrecovered investment must be tracked year by year. So year one, suppose that we have 1,000, year two, 0, means we don't have any cash inflows for the second year, 2,000 in year 3, 1,000 in year 4, 500 in year 5. So, for example, if the project requires an initial investment of 4,000 and provides uneven net cash inflows in year 1 to 5, as shown, the investment will be fully recovered in year 4. We need to recover what? 4,000. So year 1, 2, 3, up to 3, we are recovering 3,000. So we need year 4 for recovering the 4,000 by counting exactly like the example that we have. Okay. Any questions so far? Any question? Okay. Let's do an exercise which is related to the payback period. This exercise is 14.1. The management of Enter Corporation architect design firm is considering an investment with the following cash flows. Determine the payback period for the investment. Determine the payback period for the investment. Would the payback period be offered if the cash inflows in the last year were several times as large? And this is the disadvantage of the payback period. What are the disadvantages of the payback period? Can you see this question here? The disadvantage of the payback period, it ignores if we do have a good performance for the later years. So we are considering only for the first years. So what is the payback period if we pay investment or initial investment for this project 15,000 for the first year, 8,000 for the second year? So we need to recover how much? What is the initial cost that we have to recover? 23. So we have to count until the point that we recover our 23. The solution, you can start with the cash inflows. Go back to the question if you like. 1,000 plus 2,000 plus 2,500 plus 4,000 plus 5 plus 6. Up to 6, we are recognizing how much? Can you calculate it? 23. No. 20. 19,500. Count it. Up to 6, we still need to recover the 2,500. Up to 6, we need to recover 2,500. We do have two methods for that. I prefer the counting. Start with the first year, 1 plus 2 plus 2, 500 plus 4 plus, and deduct it from the investment. Up to 6, we are recovering up to 21,500, right? Up to 6. 25? 20,500. 20,500. So we still have 2,500 will be recovered in year 7. But we cannot say the payback period is 7 years, is it? So it is 6 plus something, right? 6 plus something. So investment in this project is fully recovered in year 7. But what is the payback period? We have to calculate it accurately. So for the remaining, which is 2,500, divided by the 5,000, and then we have 0.5. So the payback period will be 6.5 years. In other words, 6 plus 6 months, 6.5 years, or 6 years and 6 months. This is the payback period for this project. Number 2, or the question number 2, should or would be the payback period be affected in the cash inflows in the last year, where several times are larger? Suppose that we do have good inflows for the last years from 7 up to 10. It will not be affected. It will not be affected, and this is the disadvantage of the payback period. Any question for the payback? Any question for the payback? A simple topic that we can judge about our projects. The shorter, the better. This is the criteria for the payback period. The shorter, the better. And it ignores the cash flows after the payback period. Then objective number 2, evaluate the acceptability of an investment project using the net present value. Net present value. Have you heard about the net present value or present value? Present value depends on something important in accounting and finance called the present value tables. This is given. Tables are given in the books for all fields of education, let's say. We do have, or we will use in our topic, in our chapter, two tables. Table 14B, the present value, 14B1, 14B2. 14B1, if you don't like to use the tables, there is a formula over there. There's a formula. We can use a calculator to calculate the factor of the amount. How to read these tables? For the exams or the examples, we can give you the factors to use it to calculate the present value. But for your information, how to read these tables, this is called the periods, vertically, the periods, which means how many years or how many periods do I need for my investment. And the horizontal part is what? Interest rate, and most likely we are talking about the market interest rate. So suppose that I'm saying we need 5 years of 10% rate. So we are talking about 0.621. Suppose that we're talking about 5 years depending on 10%. So we are talking about factor 6 to 1 or 0.621. What does 6 to 1 means? Means the $100 after 5 years, depending on the 10% market rate, will equals today $621. This is the meaning of present value, time tables, and the present value amount. The $100 after 5 years, depending on 10% market rate, is equal today $621. This is for the present value of an amount or one amount. Suppose that I'm talking about something called annuity. What does the annuity mean? Annuity. Annuity means more than one amount to be received during the life of the project. Example. No. Example for our project, our project. Cash flows. So I'm waiting to receive more than one cash flow during the life, is it? So this is called annuity. Annuity means more than one amount to be received during the life of the project. So for the annuity, we will use table 14B2, which is the present value of an annuity. Again, if you don't like to use the tables, we do have a formula over there. So suppose that I'm saying we need to calculate what is the present value of five amounts, depending on 10% market rate. I have to look again for periods number 5 and the 10% market rate. So we do have a factor 3.791. What does that mean? What is the 3.791 means? Suppose that I'm receiving 100,000 every year, up to 5 years. So in total, I will receive what? 100 multiplied by 5. So this is $500. But the time value or the present value today is not 500. It equals to 100 times 3.791. And this is the meaning of the present value of more than one amount to be calculated today. The net present value method compares the present value of the project's cash inflows with the present value of its cash outflows, and the difference between these two amounts will be called the net present value. Net present value. To simplify, the net present value method, 2, simplifying assumptions. All cash flows other than the initial investments occurred at the end of the periods. All cash flows generated by the investment project is immediately reinvested at a rate of return equals, not so important for us now. Example, Leicester Company has been offered a 5-year contract to provide component parts for a large manufacturer. Cost and revenue information. We do have a cost of special equipment, $160,000. Working capital required for this project, $100,000. Relining equipment in 3 years, $30,000. Salvage value of equipment in 5 years, $5,000. Again, if you remember what is the salvage value? Salvage value is the cash proceeds that is expected to be received at the end of the life of the project. So we are waiting to receive the salvage value. How many times? One time only at the end of the life, which is one time at the end of year 5. Annual cash revenues and costs. Sales revenues from the parts, $750,000. The cost of parts sold, $400,000. Salaries, shipping, and other costs, $270,000. At the end of the 5 years, the working capital will be released and may be used elsewhere by the company Leicester. Leicester Company uses a discount rate of 11%, which is referring or equivalent to the market rate, okay? Should the contract be accepted or not? In this case, I have to calculate something called net cash flows. Net cash flows. Annual net cash inflows from operations. We do have sales revenues for $750,000. Sales revenues, $750,000. This is called cash inflows. Talking about sales, which means inflows. The cost of parts sold, which is outflows, $400,000, and other costs referring to the cash outflows also for $270,000. So the annual net cash flows expected from this project is $80,000. Good? Yes? So the first step in calculating the present value of the project will be calculating the net cash flows, which is the difference between cash inflows and cash outflows. Now, the net present value for the project is calculated as follows. The investment in the equipment, which is $160,000 required today. So the factor will be what? Maybe this is the tricky point for the calculations for the present value. Look at the table, please. The investment in the equipment, I need to pay now $160,000. So what is the time value of money? No time value of money, which means I'm talking about now. So the factor would be 1. 1 means the 160,000 is equal to 160,000 because we are talking about today, not for any other time. Okay, so the investment in the equipment, the years, which is the time needed for the investment, is now. The cash outflows $160,000. We have to pay the $160,000. The factor will be 1 because we are talking about today, no time value of money, and the present value will be the cash flows multiplied by the time value, which is 160. Negative means outflows. The working capital needed also now for $100,000. Now means the factor will be 1. So we do have a negative number for $100,000. The important maybe in line 3, the annual net cash inflows. The annual net cash inflows. What does that 1 to 5 means? 1 to 5 means what? We are waiting to receive cash inflows from year 1 to year 5. So we will receive 80,000 net cash inflows in year 1, 80,000 in year 2, year 3, year 4, year 5. So each year we are waiting to receive $80,000. In total, what is the total amount of the cash inflows? Total amount of cash inflows. 80 multiplied by what? 5. 80 multiplied by 5, which is 400,000. 400,000. 80,000 multiplied by 5 times 5 years. So we're waiting for $400,000. But today it is not equal to $400,000. And this is the topic of the present value. I'm waiting to receive $400,000, but for 5 years. So what is the present value of today's amount? We will say, or we will use the factor, and this factor is given from the tables, which is the conjunction between what? 5 periods and what? 11%. We have a factor of 3.696. Which table, by the way, 1 or 2? 2. Why? Because we are talking about annuity, which is the second table. The first table was talking about what? One amount to be received after 5 years. Table 2 was talking about what? Annuity, which is more than one amount to be received during the future. This means 3.696 multiplied by 80, the amount of the cash inflows, the present value of the cash inflows will equals to 295,680, which is the present value of the 400 today. Any question for this? Any question? Okay. What else? I'm waiting to receive something else. The relining of equipment in year 3. We need a maintenance for the equipment will be done in year 3. Is it paid for one time or for more than one time? One time. The relining or the maintenance of the equipment will be paid one time in year 3, which means I will use which table? The first table. First table means the present value of the amount today. In year 3, we need to pay 30,000. Pay means between brackets, cash outflows. We need to pay 30,000 in year 3, multiplied by a factor, and this factor comes from table 1. So the amount or the present value of 30,000 to be paid in year 3 today is equal to 21,930. Any question for this? Another thing, we are waiting to receive in year 5, we are waiting to receive 2 things, the salvage value and the working capital. The salvage value is received for one time or 5 times? One time, which means I have to use the first table. So I'm waiting to receive salvage value, which is the scrap of the equipment or your asset in year 5, multiplied by a factor comes from table 1. So the present value present value of the salvage value will be 2,965. Present value, which is the value of the salvage value today. The 5,000 after 5 years is equal to 2,965 today. The working capital released, which is the amount to be received one time after 5 years. The 100,000, again, I'm using the first table. 100 multiplied by 0.59 will equal to 95,300. Any question about how to calculate these numbers? So the total will equals to something called net present value of the project. Net present value of the project. So adding these numbers together, we have $76,015. A positive net present value means we will accept the project. Accept the contract because the project has a positive net present value. Net present value should be a positive in order to accept the project. Last thing, another example, Denny Associates has been offered a 4-year contract to supply the computing requirements for a local bank. We do have a cost for the computer, 250,000. Working capital required 20,000. Upgrading equipment in 2 years. 2 years means one time or more than one time? One time. Upgrading the equipment in 2 years means after 2 years. In 2 years means after 2 years, I have to maintain or upgrade my computer. Salvage value of equipment in year 4 means one time after the 4 years. Annual net cash inflows 120,000. The working capital will be released at the end of the contract. Denny Associates required 14%. 14%. What is the net present value of the contract with the local bank? We have to calculate it, is it? So we need this table. We need this table. We need to prepare this table. The table includes what? All the cash outflows, all the cash inflows. Investment in the equipment required now for $250,000. The factor will be 1. Why? Because the time is 0. The time is 0 now. So 250 between brackets. Working capital needed 20,000 also now. Time is 0. Annual net cash inflows $120,000. $120,000 more than one time. Yes, the $120,000 will be received 4 times. So we will use what? Annuity, which is table 2, 2.914. How to get this number? Conjunction between what and what? 4 years? 14. 4 years and 14, we will have 2,914 multiplied by 120, this equals to 349 something. Upgrading of equipment in year 2. In year 2 means again, I will pay that amount after 2 years. So 90,000 using the first table will equals to 69 something. The salvage will be received one time also, 10,000 using the first table will equals to 5,920. The working capital released will come back after 4 years. Again, the 20 will be come back. So we need the factor after 4 years and the 11,840, which is 20 multiplied by 0.59. We do have a net present value of 28,230. Does that mean we have to accept the project? Yes, because what? A positive net present value. A positive net present value. Thank you.